Welcome back to the deep dive. If you want, a true masterclass in how to build an unbreakable business moat and then use it to generate just jaw-dropping returns, you have to look at our subject today.
TransDigm Group, or TDG as they're known.
Exactly. And this is not some flashy tech stock grabbing headlines.
Not at all.
This is a deep in the supply chain, highly specialized industrial company, aerospace and defense components.
Right.
And today we are diving right into their fiscal year 2025 results, which just came out. And our mission is really to understand the paradox of TDG. How do they generate these massive, massive margins while running one of the most debt-heavy financial models you'll ever see?
It really is the ultimate high-wire act. And
Yeah.
you can't even start to understand it without looking at two numbers right up front.
Okay.
First, that profitability. For FY 2025, they hit an EBITDA as defined margin of 53.9%.
53.9.
For a manufacturing company, that is just phenomenal.
Okay, wait, let's pause right there because that term gets thrown around. What exactly is EBITDA as defined? That's TDG's own metric, right?
That's crucial, yeah. Most companies report standard EBITDA. TransDigm's as defined version, well, it strips out specific non-cash charges, acquisition costs, things like that.
So it's their view of pure operational cash flow.
Precisely. They're telling the market that for every single dollar of sales, over 50 cents drops straight down to cash that's available for, debt service and shareholder returns.
And that leads directly to the second number, I'm guessing.
It does. That massive $90 per share special cash dividend, they paid out. A payout funded mostly by taking on $5 billion in new debt.
Wow. Okay, so let's unpack that. If that's where the magic happens, we need to understand what exactly TDG sells. Why are their products so bulletproof?
Well, their entire business model is built on one thing: highly engineered, proprietary aerospace components.
Proprietary is the key word there.
It's everything. They design and they own the intellectual property for parts that are complex, critical for safety.
Yeah.
They're not selling you standard nuts and bolts.
And the real genius here isn't just selling that part to Boeing or Airbus for a new plane, is it?
No, that's just the start. The real value is the revenue stream that follows for decades.
Decades.
Think about it. Once their part, let's say a specific fuel pump, is designed into a new aircraft, they are set. The production run for that plane might last 20 or 30 years.
Right.
But then the plane itself flies for another 25 or 30 years.
So you're looking at a product life cycle that's, what, over 50 years?
Often in excess of 50 years, yes. And for that entire time, TDG is pretty much the only place you can go for that replacement part, that of the moat.
Let's talk more about that moat. Why can't a competitor just, reverse engineer a part and sell it cheaper?
Regulation. That's the barrier to entry.
The FAA, Department of Defense?
Exactly. These parts are safety critical. Getting a new supplier certified for an existing part can cost millions and take years of paperwork and testing.
So if an airline needs a replacement,
It is exponentially cheaper and faster for them to just buy the certified original from TDG, even if TDG prices it at a premium. And they do. That barrier just shields them from competition.
and that context makes their revenue numbers make perfect sense. How does that actually break down in the sales mix?
Well, the stability comes from the aftermarket.
Yeah.
In fiscal 25, about 55% of their net sales came from that aftermarket, repair and replacement.
And that's the high margin stuff.
Incredibly high margin. And provides stability even if, new plane production slows down.
And just to give a sense of the scope here, we're talking about everything from aircraft seat belts to cockpit security systems, right?
Oh, yeah. Even components for NASA's space telescopes. They also have a smaller non-aviation segment making things like valves for gas turbines. It's adopting the same proprietary model, just on the ground.
So we get the why, that stable proprietary aftermarket. Let's connect that to the how much. Fiscal 25 was a pretty strong year. How did the numbers look versus 24?
The growth was really robust, driven by that aftermarket. Net sales climbed to $8.8 billion,
Up from
just under $8 billion in 2024. So that's about an 11.2% increase.
Yeah.
And you see that leverage drop down. Income from operations went from about $3.5 billion to over $4.1 billion. That pushed their operating margin up to 47.2%.
And that gets us back to that 53.9% EBITDA as defined margin we started with.
It does. It all connects.
And for investors, how did that translate to adjusted EPS?
That's a huge jump. Went to $32.08 for the year, up from $25.62. So yeah, the machine is definitely running smoothly.
What's fascinating to me, though, is that even in a great year, they still pointed out a pretty significant headwind.
They did. I mean, they're getting more efficient, leveraging their fixed costs, but they specifically called out the commercial OEM sales. So parts for new planes
Hmm.
actually decreased.
Decreased, even with travel booming.
Yeah, because the big guys, Boeing and Airbus, are still struggling with supply chain and labor issues. They just can't build planes as fast as they want to.
Which just underscores the power of that aftermarket model. They can grow 11% even when their biggest new build customers are struggling.
Exactly.
Okay, so that brings us to the engine behind all this. Their strategy. It's really two parts, right? The M&A and their internal value system.
Right. They call it the value-driven operating strategy and the selective acquisition strategy. It's all about feeding the machine with these defensible businesses and then just extracting the maximum cash.
They lay out these three core value drivers. Let's touch on those.
Sure. The first is getting profitable new business, and the third is pricing their products to reflect the value they provide, which, we've talked about.
But that second one, improving cost structure, that sounds a little like corporate jargon, but for TDG it feels aggressive.
It's very aggressive. For them, it means being ruthlessly lean. When they buy a company, they are famous for coming in, integrating fast, and stripping out all redundant overhead.
All the fat.
All of it. They focus every dollar on production and cash generation. That's a huge piece of how they get to a 54% margin.
And the fuel for this entire machine is just constant M&A.
Constant. They've bought 95 businesses or product lines since 1993. They're always hunting for these niche manufacturers with high proprietary aftermarket sales.
And we saw that in action this past year.
We did. They spent over $400 million in cash on acquisitions in FY25. That included a company called Servotronics for about $133 million.
What do they do?
Servo controls and components. A perfect, critical little niche.
And they didn't stop there. They made another big move right after the year ended.
Exactly. The report notes it as a subsequent event. They closed a deal for Simmons Precision Products in October for $757 million in cash.
Wow.
And both of those get folded into their power and control segment, just constantly deepening that moat.
Which brings us to the Highwire Act itself, the capital structure. We've established this incredibly reliable cash flow, so let's talk about how they use that to support just massive amounts of debt.
This is the defining feature of the company. As of year-end, their total gross debt was over $30 billion.
$30 billion.
Which works out to a net debt-to-EBITDA ratio of 5.8 times. They were not afraid of leverage.
For any other manufacturer, 5.8x would be a huge red flag. Why do the debt markets let them do this?
It all goes back to the moat. Lenders, bondholders, they see TDG's aftermarket revenue as being as predictable as a utility bill.
So the risk isn't that their product becomes obsolete?
No. The risk is another global pandemic that shuts down air travel. And even that is temporary. The cash flow is just so dependable that it can service that high debt load.
But with interest rates being so volatile, how do they protect themselves? I mean, that debt load could become incredibly expensive overnight.
They're masters of hedging. They reported that about 75% of that gross debt is effectively fixed rate all the way through fiscal year 2029.
How do they do that? With swaps and caps?
Exactly. Sophisticated instruments. An interest rate cap is basically like insurance. If rates go above a certain level, their counterparty pays the difference. A swap lets them trade their variable rate for a fixed one. That protection is absolutely vital to their model.
And it must be expensive.
It is. I mean, even with all that protection, their forecast weighted average interest rate for next year is still 6.3%. Carrying $30 billion in debt is never cheap.
But that hedging is what gives them the confidence to go out and borrow to pay that huge special dividend.
That's the whole game. That $90 dividend was a cash payment of about $5.2 billion.
Oh.
And it was almost entirely funded by issuing $5 billion in new debt.
And their stated priorities make it clear they'd rather do that than pay down debt.
It's their playbook, written right there. The priority is capital spending first, then acquisitions, then special dividends and buybacks. Debt prepayment is last on the list.
And they're active on the buyback front, too.
Very. They bought back $500 million in stock in fiscal 25. And then, right after the year closed, the board authorized another $5 billion for future repurchases.
So to wrap this deep dive up, TransDigm has basically perfected this model. They operate in a niche where regulations create a moat, ensuring high margins and stable cash flow. And they use that dependable cash flow as collateral for an aggressive financial model that constantly rewards shareholders with debt-funded dividends and buybacks.
The whole thing hinges on that technical and regulatory moat-holding firm, which, for now, it is.
But that brings us to the final provocative thought for you to think about. Their entire strategy relies on that interest rate hedge.
That 75% fixed rate.
Right. But it only lasts through fiscal year 2029. What happens then? What happens to their cost of capital and their ability to fund these massive dividends when that huge block of debt has to be refinanced in what could be a very different interest rate world?
That 2029 date is the key horizon. That's the point where the cost of carrying that $30 billion could fundamentally change the math for them, no matter how strong the aftermarket is. It's the real pension at the heart of the TDG story.